Let's quickly do for other financial assets. There's not much about other financial assets that you should know. Well, at the end of the day, you have to be able to know what is meant by other financial assets. You must be able to classify them, to record them, and very important, to disclose them in the statement of financial position. The learning outcomes also in your study guide, so if you want to have a look a bit closer. A financial asset, now there we see that wonderful word asset once more. What's the definition of an asset, if you can remember correctly? It is a resource, in other words, how can we use the asset, controlled by the entity as a result of a past event that led to an inflow of economic benefits, and what are the economic benefits associated with that. Now, a definition of a financial asset, it can be cash, but remember cash and cash equivalents is all about cash. But there it's about cash or cash equivalents that can be converted into cash resources within a period of 3 months. So here's more longer term types of cash investments, typically to be classified as a non-current asset as at the end of the financial year end. The maturity date of that investment must be at least longer than 12 months away from year end. Any equity instrument of another entity, now what's the equity instrument? If I'm going to buy shares in another entity, that is an investment for me. Or the third thing is I have a contractual right to receive cash or other assets under potentially favorable circumstances. Now let's have a look at a few types of examples. Cash investments, we've said is already longer than 12 months, loan to third parties, and then investments in shares of other entities. Now we're going to record this financial asset that we've invested in initially at the cost price of that asset. Now that cost price, we're going to add all transaction costs that we had to incur in order to get that investment in our possession in order to use it for the value it was acquired for. So what type of transaction costs do we get? We get things like lawyers' fees, agents' commissions, other types of commissions. You get brokerage charges if you're going to buy a listed investment, and all those costs will then be capitalized as part of the cost price of an asset. Now, because we're going to show our assets at the end at the cost price of that asset, its subsequent measurement will take place at fair value. But that is not in our syllabus, and you're going to have more than enough time from next year onwards to do the fair value adjustments on these assets that you have required. Let's look at an example for transaction costs. Company A purchases an investment at fair value or cost of 400,000 Rand. Agent fees incurred amounts to 4,000 Rand. Determine the carrying value of the investment after the purchase took place. Now that would be the 400,000, which is the fair value at this point of time, but it is also the cost at this point of time, plus 4,000 transaction cost. So we're going to show that investment at 404,000 in our books. Let's assume that this is an interest-bearing type of investment. In other words, I'm going to receive interest on my investment. Now, this entity who's going to pay me the interest is the entity in whom I have the investment. And according to them, they only know about the 400,000 Rand. They don't know and they don't care about all the other transaction costs that you've incurred in order to get this investment in your possession to enable you to use this investment for the purpose that you've acquired it for. Therefore, if you're going to receive interest, then you're going to receive interest not on the 404,000, you're going to receive interest only on the cost price of your investment of 400,000 Rand. Now, cash investments is an interest-bearing instrument. When will I make a cash investment? If I have surplus funds available. Now, you can do it in money in bank accounts, savings accounts, term deposits, It's a low risk type of investment, therefore your process or the returns on that investment is not that high because you're going to receive interest payments on that investment. The lower the risk, the lower the income. The higher the risk, the higher the income. But then obviously with a high risk type of investment, there's also a risk that you can lose your money, everything that you've invested. Good. Now, for a cash investment, what are we going to do? We're going to debit that investment and we're going to credit bank with the amount that you're going to put on the investment. So the investment account will be an asset and you're going to reduce your bank account with the investment that you've made. So that investment, the debit side of that, is going to be a financial investment, financial asset. And then obviously bank or creditors is going to be credited. The interest, well, the debit leg is going to be when I receive the interest, it will happen in my bank. Or if I haven't received the interest, but I was entitled on that interest already, I'm going to have accrued income, which is also a debtor in my books, or part of trade and other receivables. It's not a debtor, it's more receivable. The credit leg is going to be interest received. So that is going to happen in my statement of profit and loss. It's an income, and that we're going to call finance income. Now, this interest income can be calculated either as simple interest or compounded interest. Now, simple interest is what we are used to. Compounded interest is interest on interest. If the question doesn't specifically state whether interest is payable simple interest or compounded interest, you can accept that it is simple interest. If I want you to calculate compounded interest, I will tell you so very specifically. Let's have a look at an example how to calculate compounded interest. On 1 January 2014, JF invested 100,000 in a 3-year fixed deposit at SS Bank at a 10% compounded interest rate. The capital and interest is repayable at the end of the 3-year term. Now, in the beginning, we're going to put 100,000 Rand in the investment account. At the end of year 1, we're going to get 10,000 Rand worth of interest. However, capital and interest is only repayable at the end of the 3-year term. I am entitled on 10,000 Rand interest in the first year, and that is why I'm going to capitalize that 10,000 Rand interest in that first year. So what am I going to do? I'm going to debit my investment account with 10,000 Rand and credit my interest income account with 10,000 Rand. At the end of year 1, then, my investment account will have a balance of 110,000. Compounded interest means I pay interest on interest. So therefore, at the end of year 2, I can get 10% interest on 110,000, not 100,000 anymore, with a capitalized interest 110,000. So that gives us 11,000. Again, we're going to debit our investment account and credit investment income in that second year. I'm going to start the third year with a balance on my investment account of 121,000. So at the end of the year, I'm going to earn 10% interest on the investment amount of 121,000, which gives us 12,100. So we are going to debit once more the investment account and credit interest income. At the end of year 3, the date of repayment, the investment account is going to have a balance of 133,100. What are we going to do now? Our bank account is going to be debited with the amount that we're going to receive from our investment, 133,100, and our investment account is going to be credited with 133,100. Please note that I have recognized my income over the 3-year period, and it's only the balance that's going to be settled now. Now, let's take another example where we're specifically going to look at the accrual principle, and more specifically, on 30 June, Worth Wills invested 500,000 in a 5-year fixed deposit at 12% simple interest per annum. So no interest on interest. Interest is earned on an annual basis. Worth Wills has a 28 February 2018 financial year end. Prepare the journal entries to show the interest received for the financial year ended 28 February 2018. Okay, so we have invested on 30 June 2018. Investment at that date, debit 500,000, bank credited 500,000. As of 31 December, we're going to receive 6 months worth of income. So they're going to pay us 30,000 Rand, 500,000 times 12% multiplied by 6 months, 30,000 Rand, and we're going to credit investment income or interest income, 30,000 Rand. 28 February is our financial year end. So although we haven't received the second part of our interest payment, that means that we can recognize the interest that we were entitled on for the period from 1st of January till 28 February. So now we're going to recognize 500,000 times 12% for that 2 months period as interest income, which is 10,000. And then accrued income or accrued interest, which is going to be a debt, part of trade and other receivables in our statement of financial position, is going to be 10,000 Rand. Now, loans to third parties, guys, has got a lot of Credit Act implications. So it's not, you cannot only do a loan to a third party without adhering to the Credit Act in this company. Now, the only time that you will do that is if you have excess money available and if you have approval from the credit regulator in South Africa. Investment in shares of a company. Surplus funds can also be invested in shares, and that can take two forms, unlisted investments and listed investments. Now, let's start with listed investments. It's like the name indicated, those shares are listed on the stock exchange, and South Africa's got 2 stock exchanges. It can be listed on either one of the 2 or both of them. The one is the Johannesburg Stock Exchange and the other one is the L2X. Unlisted investments is like the name indicates, investments companies where the shares of that company is not listed on any investment and on any stock exchange. Now that can either be a private company or public company, but their shares are not listed. Now, the purchase price of a listed investment is the amount by which the shares are traded in the public market at the date of acquisition. Now, that is, in other words, the amount that you have paid for that specific share. Now, the income or the return that you want on your share is going to be on an annual basis, the amount declared by ways of a dividend by the company. And the second type of return that you earn on your investment is the capital growth of the value of your investment over time. So capital appreciation. Now, that capital appreciation can only be cashed in once you've sold your share. If you still have the share, yes, you still have the benefit of the capital appreciation, but you will only feel that benefit once you have sold your share. Because shares are of a higher risk type than normal investments, cash investments, it means that the return that I want to earn on a share investment must also be more than the return that I want to earn on a cash investment. Let's quickly do an example, and we're not really going to do dividends this year. What you should know about this semester, we're going to do a lot of dividends next semester, but what you should know at this point of time is, should you receive dividend income, what should you do with that, and where should you show that? On 11 May 2018, you purchased 100 shares in Lion King Limited, a listed company on the JSE, for R1 per share. Lion King declared and paid a final dividend of 520 cents per share on 10 September 2018. Guys, once a company has declared a dividend, you are entitled on that dividend. So it doesn't matter at year end, your year end, whether they have paid that dividend as yet. The fact that they have declared the dividend means that you are entitled on the dividend, and then you will recognize that income in your financial statements. Good. Then the second part of this thing is you dispose of your shares on 1 December 2018 for R10 per share. purchased 100 shares initially at R1 per share and you've disposed of it at R10 per share. And they want you to do all the journal entries. Now, the first thing is you're going to have to make provision for the dividend that I have declared. 520 cents per share, you had 100 shares. And guys, dividends is also always quoted in cents per share. So I had 100 shares at R5.20 or 520 cents per share, which gives us 520 Rand. And I've paid it. So I've received it in my bank account, statement of financial position, and I credit dividends received in my profit and loss statement, 520 Rand. Good. Then I am going to sell my investment eventually at 10 Rand per share. So when I'm selling that investment, I'm going to receive 100 times 10 Rand, which is 1,000 Rand. I'm going to credit my investment. Remember, initially we only made the investment at R1 per share. So my investment account has a balance of 100 Rand, which obviously I want to get rid of now. So I'm going to credit the investment account with 100 Rand, and I made a profit on the sales transaction of 900 Rand. The profit on the sale will go to my profit and loss account, my investment statement of financial position account. That asset account will become zero. My bank is going to increase with the amount that I receive for that share, 1,000 Rand. So clearly my capital appreciation here was 900 Rand and I've cashed it in by selling my share. Good, now presentation and disclosure, very, very important. And my statement of profit, loss and other comprehensive income, comparative figures, unless I tell you it's not necessary. Under the other income heading, subheading, I'm going to show dividend income with whatever the amounts was and interest income. In my statement of financial position, on the asset side, I'm going to have non-current assets, and the first line item under non-current assets is property, plant and equipment, which we have already done. And underneath property, plant and equipment, I will have financial assets with a note and an amount and a comparative figure. ABC Traders notes for the year ended 31 December 2016, financial assets. Now, financial assets, I have to distinguish between those that's been shown at amortized cost, and that would be your cash type of deposit. 10% fixed deposit, and then you have to give particulars of that deposit to the reader of the financial statements. The fixed deposit expires at the end of 2015, and the capital and interest will be repaid at this date. The fixed deposit was pledged as security for trade payables. Now, it's only if it's pledged for security against any loan or any commitment that you have to mention that in the note. And then financial assets subsequently measured at amortized cost, share investment in Sasol, and there you're going to show me whether it's a listed share or unlisted share, the number of shares, and the entity in whom you have the share investment. This entity owns 100 shares in Sasol Limited, a listed company with a title. VAT, financial services are exempt from VAT. However, fee-based services are subject to a standard rate of 15%. What is fee-based services? That's things like bank charges, special transactional fees where you have structured a deal for them, then that will also be subject to VAT, etc., etc. Have we reached our learning outcomes? Do you know what is meant by financial assets? Will you be able to classify them and to record them? And most important, can you disclose financial assets in the financial statements? And this is not only about the asset account, also the income associated with that financial asset.